Well, after recently uploading my video, the top 10 stocks on sale right now, I got tons of comments asking for the Canadian version, so here you are. In this video, I'll be sharing my top 5 Canadian stocks on sale to buy now, given this wildly volatile market presenting some great opportunities to buy the dip. But unfortunately, I couldn't find as many here in Canada, so I narrowed the list to 5 solid companies. So recently, there's been a huge market shift from growth and tech stocks towards safer value stocks such as banks and oil companies, amid the rising interest rates and high inflation. But in my own opinion, I see tons of opportunity in growth as a long-term investor, where Canada offers some beaten down growth stocks that could do very well over the next 5 to 10 years. So guys, if you do enjoy the video, don't forget to drop a like to help support my channel. I really do appreciate that. And if you haven't already, make sure to subscribe down below with those bell notifications turned on so you don't miss any of my future uploads this year. There's also a link below if you'd like to gain access to my Discord community of investors, where you'll get to see all of my stock trades as soon as I make them, access my intrinsic value calculator, and then we also have weekly group coaching calls so you don't want to miss out. Anyways, with that said, let's jump straight into these 5 stocks on sale here in Canada. Alright, now the first stock today on sale in Canada is Shopify with ticker symbol shop.to. But on top of discussing why I think Shopify is a great buy today, I'll also be sharing why I did not add Lightspeed to this list, which is another very popular e-commerce stock here in Canada that I've been getting tons of comments about. Firstly, let's discuss why Shopify is a great opportunity right now. Shopify is Canada's largest and the world's second largest e-commerce marketplace by gross merchandise volume, or GMV, where they give entrepreneurs and businesses of all sizes the tools needed to create their own e-commerce platform. But Shopify has evolved to be much more than just an online store builder, where they also offer features such as Shopify Point of Sale, allowing merchants to sell in physical stores as well as online, Shopify Payments, allowing merchants to facilitate online transactions, Shopify Capital, allowing merchants to get loans to enhance their business growth, and Shopify Fulfillment, just like Amazon Fulfillment, facilitating the storage and shipping of e-commerce products. Overall, Shopify has an incredible recurring revenue business model where they've been able to integrate tons of features and functionality into building an online business, which is more important than ever. Recently too, Shopify announced a partnership with JD.com where they are now allowing their 1.5 million plus merchants to start selling in China to over 550 million customers annually. But this deal has not been priced into the stock whatsoever. Shopify stock is still down about 40% from its all-time highs just a few months ago, which I believe is an overreaction given nothing has gone wrong in the business. Looking at their financials, we can see Shopify has been growing at tremendously rapid rates over the past 5 years, where revenue was up 46% in the latest quarter despite having seen a slowdown since COVID began. Furthermore, they have a rock-solid balance sheet with cash and cash equivalents of $9.5 billion and total current liabilities of $750 million, which means they will not be needing to dilute shareholders to maintain their business operations. Especially considering the fact that Shopify is already a profitable business given their insane gross margins above 50% per year, which should only become much more profitable in the future. By the way guys, if you want to access this totally free stock research platform that I'm using, sign up for Inverse using the link in the description or the pinned comment below, and you'll gain access to this totally user-friendly and free research platform. Alright, but now let's take a look at a popular but smaller e-commerce company known as Lightspeed, which only has a market valuation of $5.5 billion right now. Lightspeed is growing revenues at Lightspeed rates and has a huge opportunity when it comes to e-commerce adoption over the next decade. So I can understand the appeal for Lightspeed when you see the stock down 60% in only a few months, but I'm still not touching this business, and here's why. For one, Lightspeed is still unprofitable, where they lost $75 million in the last quarter, and the business is continuing to lose more and more money. For instance, Lightspeed's revenue grew at 192% year over year, but their direct cost of revenue increased 282% year over year, which is not a good sign at all, and as a result, their gross margin is getting smaller, which has a huge impact on profitability. And it's very probable that management will have to dilute shareholders or take on massive amounts of debt to continue growing their business operations once they burn through the cash on their balance sheet. At this point, I really don't see Lightspeed becoming profitable anytime soon, so I'm going to be avoiding this stock and sticking with Shopify, which is trading at a higher valuation, but they are growing their margins and they're seeing a lot more profitability. Not to mention, unprofitable stocks are getting killed in this market environment, and you really don't want to own unprofitable businesses when you're seeing rising inflation. So as I said in my investing plan for 2022, I will be avoiding businesses with no signs of near-term profitability. Anyways, that leads me into our second Canadian stock on sale today, and that would be Nuvei with ticker symbol NVEI.TO. And this company actually partners with Shopify. Nuvei is Canada's largest non-bank payment processor and technology platform that facilitates all kinds of payment methods in all kinds of currencies, including crypto, and in all kinds of ways. Essentially, Nuvei is just a fully integrated payment solution that removes barriers for merchants, optimizes operating costs, and increases acceptance rates across the board. And as we can see, the stock price is now down about 60% from all-time highs and is trading for the same price it did over a year ago, while it is still up about 55% since going public back in September of 2020. However, unlike Shopify, Nuvei is a smaller cap stock worth only $10 billion, which does mean that it carries more risk. So why do I think that Nuvei is a good buy right now? Well, for one, Nuvei is a profitable business. In the most recent quarter, Nuvei produced adjusted diluted EPS of 42 cents, being up 152% year over year, and GAAP diluted EPS of 19 cents. Also, the entire past 4 quarters have been entirely profitable for Nuvei, where they made $1.54 of adjusted diluted EPS and 80 cents of GAAP diluted EPS, which is great to see. So on an adjusted EPS basis, which factors out a lot of the non-recurring expenses, Nuvei is trading at a trailing PE ratio of 47 right now, whereas on a GAAP basis, they are trading at a quite elevated 92 trailing PE ratio. But given their incredibly high revenue and earnings growth rates, the valuation should compress substantially over the next few years. The next reason I think Nuvei is a good buy is because 85% of their revenue is e-commerce based, meaning that they will continue to benefit from secular trends moving online. This is evidenced by the fact that Nuvei's management expects to see 30% plus revenue and GMV growth over the medium term. Finally, Nuvei's total addressable market, or TAM, is estimated to be $20 trillion, which is humongous, but of course this likely represents GMV, where they would only earn a small fraction of this over time. Regardless, with the business being worth only $10 billion right now, I could see this being a 10-bagger over the next decade. Alright, now the third stock on sale right now is Canadian National Railway with ticker symbol CNR.TO, and I know you've heard me talk about this before, but hear me out because this business is on fire right now. And I won't go over much of the background because most of you already know this is the largest railroad in Canada and one of the largest in North America, making this a very solid business model. So anyways, over the past month, CNR has been trading for a bit of a discount where the shares are down about 9% from all-time highs, which isn't a fire sale by any means, but CNR stock also hasn't shown many massive dips over the past few decades, as this is a very solid company. As for why CNR is on fire right now, they just reported their Q4 2021 earnings and the results were outstanding. CNR grew its diluted adjusted EPS 20% year over year to $1.71 per share, while its adjusted operating ratio reached a new Q4 record of 57.9%, which is simply the operating expenses as a percentage of revenues. And these great results came because they were able to reduce operating expenses year over year while increasing revenue 3% to $3.75 billion, so I think that's incredible. Moreover, CNR's outlook for 2022 is to deliver 20% adjusted diluted EPS growth, again over 2021 levels, which I think is just insane for such a large and established railroad. But with higher levels of inflation, railroads tend to benefit from this, so that is one of the main reasons why I think CNR is a great buy on this dip. Here we can see that CNR continues beating levels of rail inflation, excluding fuel costs, by increasing their same-store prices across all business segments. As for the dividends, CNR made a bold move and increased the divvy by 19% year over year, marking the 26th consecutive year of dividend increases, which is remarkable. Like guys, with a normal dividend stock, I would be super stoked to see a 10% increase of the dividend, but 19% is ludicrous. Finally, the company also announced a new share repurchase program where they plan on buying back 42 million common shares within the year, which represents nearly 6% of the company's entire float. Overall, I couldn't find a single thing I didn't like about this earnings report, and it just seems like CNR is going to continue benefiting from these inflationary times, which makes this one of the best buys here in Canada. Alright, now the fourth Canadian stock on sale right now is Brookfield Renewables with ticker symbol BEP-UN.TO. So Brookfield is the largest pure-play renewable energy company here in Canada, where they own and operate hydro, wind, and solar assets, and this has been one of the fastest growing companies in the sector by a long shot over the past half decade. However, Brookfield stock has been hit pretty hard in the past year, being down over 28% and down 33% from its all-time high back in 2021. But over the long term, this has been a solid stock to own, still being up 600% since 2000. Now, when I first glanced at Brookfield's financials, it actually caught me off guard because it appears that the company is very unprofitable and that they're losing more and more money every year. However, taking a closer look into the cash flow statement, you come to realize that Brookfield produces tons of cash from operating activities, and the net income is only negative because of the massive amount of depreciation they can claim on their renewable assets. So from this operating cash flow, Brookfield calculates a quantity known as funds from operations, or FFO, and that has allowed them to consistently pay and increase their distributions annually, which they are targeting to grow at 5 to 9% growth per year into the future. And right now the distribution yield is at 3.7%, but this should soon be increasing if I had to take a guess based on their historical payments. However, do keep in mind that these are distributions and are taxed differently from dividends. But while they are paid out in USD, there shouldn't be a dividend withholding tax within your TFSA, so you can rest assured about that. As for valuation, Brookfield is trading for a price to Q3 annualized FFO of about 25, which I think is quite reasonable considering the future growth of the renewable energy industry Brookfield should benefit from over the next decade. Furthermore, the company has $3.3 billion in liquidity on the balance sheet with no meaningful near-term maturities, meaning that there should be no sign of financial instability anytime soon. Now, another reason Brookfield is such a solid investment right now is because of their power purchase agreements having a weighted average remaining duration of 14 years, which means they can reliably forecast cash flows far into the future, and so distributions should be solid. Overall, I honestly think this is a staple company for any Canadian's investment portfolio because Brookfield's going to be around for the long term, and we're only going to see more renewable energy adoption. And finally, that leads me into our fifth and last stock quite nicely because this is another renewable energy company, and this would be known as Greenlane Renewables with ticker symbol GRN.TO. Greenlane Renewables focuses on the decarbonization of two huge sectors, being the natural gas grid and the transportation sector, by offering an innovative solution to producing renewable natural gas from bio-waste that is immediately ready for pipeline use. Now, something to note is that this is a very small cap stock, having a market cap of only $160 million fully diluted, so naturally it is going to carry some more risk than some of the other stocks on this list today. However, I do believe Greenlane stock has fallen a bit too hard lately, being down over 60% from its all-time highs earlier in 2021, and therefore could be a very good buying opportunity for the following reasons. Firstly, Greenlane has quite a large TAM, which according to the International Energy Agency will cumulatively be worth $90 billion of biogas upgrading equipment by 2050. And considering that they are the leading biogas upgrading manufacturer in the world, this does put them in a pretty good position to capture a lot of this TAM. Along with the fact that renewable energy trends will be favoring this transition, so Greenlane's opportunity keeps getting larger and larger each year. Secondly, Greenlane has been growing their revenue at ridiculous rates ever since going public a few years ago, where revenue grew 106% year over year to $13.4 million in the latest quarter, while they have a huge sales backlog of over $47 million. Thirdly, Greenlane just announced a contract with FortisBC for $12.1 million for a project at a landfill in Vancouver, which I believe gives Greenlane significant credibility, having been hired by BC's largest utility company. Fourthly, Greenlane has lots of cash on the balance sheet, over $35 million in fact, while they have no debt. And you know what Peter Lynch says, a company cannot go bankrupt if it has no debt. Fifthly, Greenlane's valuation is getting quite compelling for its growth rate. Just check this out. Looking at their EV to sales ratio, which is simply calculated by subtracting their net cash of $35 million from the market cap of $160 million, and dividing that $125 million by their 12 trailing month sales of $47 million, we get an EV to sales ratio of 2.6, which is incredibly low for a company growing this quickly. And finally, I also love Greenlane because they're on the verge of full profitability, having earned $52,000 net income in Q3, but this should get much better as their margins are continuing to increase. So overall, I think that Greenlane Renewables is a solid small cap stock, not having too much risk because they do have tons of cash, no debt, and then a huge sales backlog, so that is great to see their growth will be propelling into the future. Anyways, that is it. The top 5 stocks on sale here in Canada Canada are Shopify, Nuvei, CNR, Brookfield Renewables, and Greenlane Renewables. So let me know what you thought about this video down below. Do you like these stocks? Do you have any better picks? Just let me know, I would love to hear it. Also guys, just leave me some of your Canadian stock picks that you'd like me to analyze down below. I would be happy to do them at some point in the future. So anyways, if you did enjoy, make sure to drop a like on the video because it does help me out, and don't forget to subscribe so you don't miss any of my future uploads. And with that said, I will see you guys in the next one.